Hello, everyone, and welcome into CrushTheStreet.com. I am Kenneth Amaduri, and I'm joined today with a very special guest, Amir Adnani, chairman and founder of GoldMining, Inc. We're going to be discussing the economy today and investments on two fronts, gold and uranium. Now, Warren Buffett has famously described savvy investors as those who purchase straw hats in the dead of winter. And I really want to use that framework when we discuss uranium today, because uranium is being underappreciated, underloved, and overlooked, quite frankly, in this environment. And I think this is going to be a very, very interesting commodity going forward here, especially when we start to get into the deeper dynamics and the fundamentals behind it. So GoldMining, IPO'd in 2011, has been focused on basically one thing, that's purchasing projects throughout the Americas, 15 different projects, gold ounces in the ground, as well as uranium exposure during the depths of this resource bear market. And GoldMining is a company that trades under ticker symbol GOLD on the TSX and GLDLF on the US side. So without any further ado, Amir Adnani, thanks for coming on Crush the Street with me today.
Good to connect with you. And it's been many years since we made our first acquisition in 2012 and connected with you even back then to talk about our very first acquisition. And then here we are 8 years later and recently having made more news, more acquisitions, and really having built this very diversified portfolio with GoldMining. And as you mentioned, exceptional time here with the gold market and the price of gold.
Well, let's start right there, Amir. The price of gold, $1,700 gold. On a macro level, what's led to the $1,700 gold price in your opinion?
Well, it's really, in a way, you could say, everything we knew that was happening in terms of the amount of debt in the world just getting out of control because of COVID-19 and the result, the policy response to that. I mean, look, there's obviously a human element to all of this that is painful and something that we need to endure through. But at the same time, this notion of unlimited quantitative easing, right? The idea of trillions of dollars of liquidity injection and the continued suppression of real rates into negative territory as we try to deal with the economic impact of COVID-19. This has led to stronger gold prices, and it's going to continue to drive the gold price. As you and I speak today, just this morning, I mean, every day you're seeing more and more major banks come out and make the case for gold. And today was JP Morgan. JP Morgan coming out and making the case for gold and saying, in their report that gold is a beneficiary of real rates staying depressed due to economic weakness. And that's it. I mean, and you're talking about historic amount of damage that has been done when you look at the unemployment numbers, historic amount of liquidity that has to be injected. JP Morgan points out that the price of gold is correlated to the size of central bank balance sheets. As the size of central bank balance sheets balloons, as they basically inject more liquidity and take on more on the balance sheet, the gold price will go up. And the balance sheets, you look at how it's ballooned since this COVID-19 crisis began. The Federal Reserve is now over $6 trillion is the size of just their balance sheet. So look, it's pretty amazing. And in terms of just how both concerning it could be and how unprecedented it could be, who would have thought even a year ago that if you said you believed the gold price was going to $3,000 an ounce, if you said a year ago, you think it's going to $3,000 an ounce, people may have said, oh, you're just a gold bug. You're one of those crazy gold bugs. Well, now it's the Bank of America calling for $3,000 an ounce gold. That's their 12-month target. And by the way, they're raising their target from $2,000 to $3,000. And so we have an environment that I got to tell you, as an entrepreneur and someone who personally believes in the in gold as a imperative asset class in my own personal portfolio, and I'm the largest individual shareholder in gold mining. I never thought that we could end up with this type of backdrop, with these types of economic conditions, because I think this will lead to the strongest bull market in gold that we've probably seen in history. And we're in the very early innings of this, and let's see how it all plays out.
It's amazing how you point out that the mainstream headlines are, what only the gold bugs were talking about, the conspiracy theorists. And here we are, massive points being dropped on the stock market, negative oil prices. I mean, so many things that are breakdowns in the economic system, trillions of dollars being thrown at the system, the unemployment rate skyrocketing. What are your thoughts, before we go a little bit deeper into the company, what are your thoughts on the overall stock market? Do you believe that we're going to see some more problems, systemic problems in overall equities, and how does that play into gold?
Well, again, I think it's this issue of how much liquidity has been injected into the system with the suppression of real rates. It is becoming almost impossible to just either sit on cash or just sit on treasury notes that are going to basically return negative yield. This idea of negative interest rates, which is, again, it's economic insanity. And we've ended up even with negative rates in the US now. You saw the Wall Street Journal piece come out, and the administration argued that no, we're going to get in the way of that. We won't allow that in the US. Well, the rest of the world's gone negative. And again, so part of, I think, the whole issue here is governments and central banks seem determined to do everything in their power to suppress real rates so that you as a saver are not going to save cash, that you're somehow in the chase for return are going to go into something else, stock market, housing, whatever the case might be. And look, that's obviously what that's driven this rebound in the market. I mean, there's something like, I think that the amount of liquidity that's been injected into the system somehow magically seems to be the cumulative gain in the stock market since we had that drop in late March, early April. As to where we go from here, it's going to come down to obviously all those things that I don't have a crystal ball, but it's going to come down to how does the reopening of the economy go? How do people get back to a new normal? What does that translate to in terms of jobs and economic activity? And ultimately, how quickly do we get the vaccine? And all those things we all know about. But in an environment where it's difficult to have an answer to all those questions, and you think about all the moving parts of those questions, gold becomes the ultimate not only saving account, because it's no one else's liability. You can't just print gold, gotta mine it. And so in an environment where we're seeing probably the most historic intervention by central banks in fiat currency, the fiat currency experiment, I don't want to say it's coming to an end, because I guess they can just keep going, right? This whole notion of QE to infinity and beyond, right? They can just keep going with printing. Gold becomes the ultimate answer and the ultimate protection almost against this grand experiment with the fiat currency, and we're seeing it on absolute steroids right now.
There's certainly been a momentum change with the gold sector. And, pointing out what has happened throughout the years, firms have cut exploration expenditures during the years, resulting in gold resources found by miners hitting decade lows, as you've pointed out. How do you see this evolving in this new environment with rising gold prices? And, what does the sector start to look like as we go into a bull market environment and not a bear market?
Well, it really started about a year ago. And for every industry, every sector, when you have a prolonged period of underinvestment and a long bear market, as you're coming out of that long bear market cycle, you start to see M&A activity as the sector just focuses on companies getting bigger, getting more efficient. And it started a year ago with the biggest companies in the sector. I'm talking about Barrick and Randgold, the merger that happened there. I'm talking about Newmont and Goldcorp, those two companies getting there. So when you get an instance in any industry, and it happened in gold, where the big boys get up and put their big boy pants on and start to do M&A, that then starts the ball rolling. And Kenneth, this morning when I woke up, I think I read about 3 or 4 different M&A deals in the gold sector. Here we are almost a year later. Bought deal financings, etc. The sector has gotten to the point where after the big boys start to get together and do M&A, now you're seeing more and more merger and acquisition take place, where companies are trying to beef up, get bigger, have more resources in the ground, have more development that becomes the pipeline for future production. There's definitely momentum coming back into the gold sector. And it's happening at a complicated time because with COVID-19, you also have a lot of mine disruptions.
Amir, let me jump in right there. I'd like to ask you about that. The supply disruption with COVID-19 has been a very interesting topic. I had it here on my notes. What has that been like for the miners, and how is that impacting the sector at the moment?
Well, it's impacted the entire supply side for gold. As I was just saying, you've had disruptions at the mine level with operations having to shut down for health and safety reasons, all the way up to getting gold bars in the right size for either the London market for settlement or the New York market for settlement, refineries that have shut down because of that. But Kenneth, I want to step back for a second because look, with COVID-19, we have had disruptions and that's impacted the market. But we're in a phase now where the market is trying to reopen from COVID. So I think there's even a bigger impact, which is going to be with us for longer. And that's the impact of underinvesting in exploration by the whole industry over a long bear market. Bank of America had in their report earlier this year that since 2012, there's been a 40% decline in reserves and resources for gold producers. That will have much longer impact in terms of shortage of gold in the ground for the miners than the impact of COVID. And that issue has to do with that as we had a low gold market environment and low gold prices for a very long time from 2012 onwards, companies just had to cut back on spending. They had to cut back on buying assets. And this is why our business strategy with gold mining was so focused on buying assets at exactly the time where no one else was interested in it. The majors were not interested in buying. And so today we have a situation where the gold industry, the gold producers, their pipeline of resources and reserves is at a decade low. That's not going to get resolved over 1 month or 1 year. That's going to be, that really is, I think, the underpinning for the next bull market in gold, where you're going to have the producers making more money because of elevated gold prices and investment appetite for companies that can explore and develop and provide and create the pipeline that then the producers can benefit from and harvest to produce more gold as we move forward.
Amir, you and gold mining have been one of the most aggressive acquirers of gold projects during the bear market, as you were pointing out there. Talk to us about the strategy. Maybe remind people of what this time period was like acquiring during the bear market and kind of how this is changing and how it's changing for gold mining specifically.
Well, I mean, part of the strategy really, again, had to do with sticking to a business plan that we had seen get done before in previous cycles, looking at companies that had implemented a buy resource in the ground and accumulate a large resource. You look at companies like Pan American Silver. You look at companies that have done it in the copper space, like Lumina Copper. We viewed this as a strategy that could be done successfully. To implement this kind of strategy, you needed a prolonged bear market. So we ended up with that. We didn't know how long the bear market was going to last, but we knew we wanted to buy resource stage gold projects for less than the discovery costs, and for lack of a better term, just buy and hold. Buy and hold and build a portfolio. And you had to attract like-minded people, investors and backers that would understand this strategy and could commit to it long term. You look at some of the early investors that we attracted from 2011 to now that have still been with the company. Groups like Sprott and lead investor there, Rick Rule. Individual investors like Doug Casey, Marion Katusa with his KCR fund. You look at Brazil Invest, one of the oldest investment firms in Brazil. These groups have backed the company from the get-go, saying, let's go and buy gold resources. Let's buy it in the ground. Let's keep it in the ground, and let's create that snowball effect, where with every acquisition, you have more and more ounces of gold resource in the ground. Kenneth, we've done this since 2012. Today, we have projects in 5 different countries. We're in the US, Canada, Brazil, Colombia, and Peru. And I don't think, I am not aware of another company, a small cap market company, a pre-production company like us that has this many projects, this much in terms of gold resources as we do in the world. I think we're truly in a leading position for a small cap company to control 10.5 million ounces of gold resources in the measured and indicated category, and 13.7 million ounces of gold in the inferred category. So the total acquisition cost for us has been just over $80 million. But if you look at what we acquired, and which were all previously public companies, and you look at their market cap back in 2010, 2011, the combined market cap of what we paid $80 million for was over $800 million. And so again, it gives you a context that we felt it was an important time to go out there and buy accretively. We've been acquiring for 10 cents on the dollar, truly buying at a low historic low point for the gold market in retrospect. And now sitting in a position where you couldn't replicate what we've done since 2012 today. There's a revaluation in the gold price. There's a revaluation in gold equities. Everything is moving higher. And so I think our timing was really, in hindsight, the best timing you could have had to buy and accumulate and build a very, very large diversified gold resource portfolio.
Amir, I really want to get into uranium. You're a special person to speak to about this. Uranium is up 40% this year, pretty substantial. And it's a sector that's been largely misunderstood, hated, overlooked, and not a lot of people even follow it, to be honest with you, at the moment, because of what we're seeing at the moment. But I really want to put a spotlight on this. I think it's important to be looking at it. And so if you can give us an idea of what's going on in the uranium sector at the moment, and as it pertains to gold mining, what are we seeing at the moment?
Well, listen, I mean, if you have to be, I think, a contrarian, or had to be a contrarian to invest in gold over the last 7 or 8 years, you had to be probably a contrarian on steroids to have invested in uranium over the last 9 years. It was the ultimate kind of contrarian situation, truly hated and truly out of favor since what happened in Fukushima in Japan in 2011. And in most, like almost any commodity business is a cyclical business. And so with uranium, we've gone through a 9-year period of the market rebalancing from a supply-demand point of view, and finally ending up in a situation where supply for uranium had become tighter due to mine closures. And now this year, with supply disruptions, again, because of COVID-19, the uranium price was even further impacted. Almost half of global production this year was impacted or was shut down due to COVID-19 on a monthly basis. So every month, this is being reevaluated by the miners that have those projects. But ultimately, it's led to the uranium price increasing by 35%, reaching $33 per pound, which is a 4-year high for the uranium price. And there definitely does seem to not be structural deficit in the uranium market and possibility for a supply deficit this year. All of that means that for gold mining really benefits from the fact that in 2013, when we acquired a gold company with gold assets, it had a non-core uranium project in Canada's Athabasca Basin. And so this for us has become a free call option on uranium inside of gold mining. We don't spend any money on it. It's not our core focus, but it happens to be a significant land package in partnership with France's Orano, where they own 25%, we own 75% of the Rhea uranium project at a time where uranium prices have really recovered nicely. This is a project that we've always viewed as being non-core and possibly it's something we can monetize, sell, or joint venture. And it's exciting to be in a position where you have so many projects and the optionality to be able to whether develop or monetize. In the case of the uranium project, our plan is to sell that or spin it out. So we'll see what's the best solution for that. But exciting time for uranium for sure. And if you look at gold mining, that's an added benefit in there that is available to our shareholders.
So, Amir, how important is uranium to global energy? I mean, it's a national security issue, something that you've pointed out in other interviews. We've talked about it before. Talk to us a little bit more about, the need for uranium in our world today.
Well, it is the largest way to generate baseload power. Baseload power being the form of electricity generation that's continuous, without interruption, that's carbon emission free. So you're talking about a world where, from a population standpoint, we've got over 7 billion people, and population growth has taken us higher, and everyone needs more electricity. And we're looking for ways to meet our electricity needs that are increasing, but at the same time reducing our carbon footprint. And so in that context, there is a growing shift by climate scientists, policymakers, and just the day-to-day people to say, I need a diversified energy mix. And in that mix, renewables on their own won't do it. They work 25 to 30% of the time. That's wind and solar. Nuclear power works 95% of the time. And it's an incredibly powerful way to generate electricity from a very small amount of fuel. So you don't need to move a lot of the actual fuel source around the world to generate the power. So today we're seeing a situation where demand for uranium, led by more and more reactors being built in the world, is back at a 9-year high. There's over 50 reactors under construction in the world. 47 reactors have been connected to the grid just in the last 7 years. And in the United States, most of your listeners may not recognize, but 20% of electricity generation in the US is from nuclear power. And the Department of Energy, because of a directive that was issued last summer by President Trump, came out with an investigation and a report and a set of policy that they've outlined recently in a report that is aimed at rebuilding America's nuclear energy and uranium mining industry, highlighting that the industry is critical to national security, energy security. And when you read it, it's different to have a mining company executive talk about the virtues of something. But when you see that you've had a very comprehensive report developed out of a process which was interagency, interdepartmental, cabinet level secretaries that work together to study this. And its conclusions are that, again, nuclear power and nuclear energy is intrinsically tied to national security and energy security. These are powerful concepts. And so there truly is, I think, this growing recognition from policymakers on the political side, climate scientists, utility companies, that all look at nuclear power and say, and let's not forget names like Bill Gates. I mean, Bill Gates has been investing a significant amount of his personal capital into next generation technology for nuclear reactors. And so you're seeing, in the 15 years that I've been in the business for uranium mining and nuclear power, an incredible convergence of support from different groups that all recognize the fact that nuclear power could be the largest, lowest cost way to generate emission-free electricity.
All right, Amir, I have 3 more questions for you before I let you go. We saw the WTI price for the May contract go negative for May,
Right.
Something that was a complete breakdown in the market. Oil being an energy source, of course. Do the economics of what's happening in oil ultimately help, hurt, or act neutral for the uranium sector?
Again, I think that it's a key about what source of energy is used for. Oil is primarily used for transportation, and whether it's transporting commodities around the world, and primarily with basically all flights or majority of flights, grounded. That's and people not driving around as much. Those are the main drivers for oil. Whereas uranium is used in nuclear power plants for electricity generation. And we're not yet at a point where electric cars dominate, what's on the roads. And so ultimately, what I would say, if we end up, and what we've seen so far, we have seen a decline in overall energy consumption, but it hasn't hit nuclear power and that base load electricity generation that nuclear provides. So if you and I want to sit at home, use our iPad, use our iPhones, continue to be active, even if we're sitting at home, we need electricity for that. And the best way to get that, whether it's whether the sun is shining or whether the wind is blowing or not, it's nuclear power. And so there isn't that relationship per se between oil and what's happened to the oil market and the oil prices and demand for uranium. In fact, at the exact same time that oil prices were going negative, uranium prices were surging to the 4-year high that we were talking about just recently, right? So actually we witnessed exactly that dynamic live in the last few months.
Yeah. Well, it's powerful. And, you know, when it comes down to it, there's a very small number of uranium companies to actually invest in. So what does this suggest about the market when the uranium price really does start to move?
I think the entire sector, entire combined market capitalization of the uranium mining sector is less than $10 billion. And it's just a very tiny sector, and it's tiny because it's endured, as I mentioned at the outset, a brutal long bear market approaching almost a decade. I think in 2007, at its peak, the combined market cap of all uranium companies globally was well over $100 billion. And so, look, I think it's a sector that is not well understood. It's on their own. Big banks don't write research about the uranium companies, the individual ones. And if they do, it might be extremely selective about one or two of the bigger names. So ultimately, as we witnessed in previous bull markets for uranium, 2005 is an interesting time. 2005, 2006 was very similar to today. We were coming out of a long bear market environment. And I think there were 20 uranium companies in the world in 2005. By 2007, there were over 600 uranium companies in the world when uranium prices went from $20 a pound to $140 a pound. Mm. And so today, the uranium price, after a long period of being stuck in the $20 range per pound, has moved to $34 per pound. It takes time to see the market develop and the price to develop further. So, but as it does, and I think that we could see a repeat of previous bull market cycles for uranium, 06, 07, and 2010, 2009 timeframe. These were exciting times, and it definitely seems like we have some exciting times coming up ahead of us for the uranium sector.
Well, I appreciate that. Amir, as we've discussed throughout the interview here, there are many reasons to be bullish on gold mining, to be frank. But I'd like to ask you in closing, what component of the story has you most confident in the future upside potential?
I think ultimately it is it's what you know you have in terms of your mineral resource. Exploration, from the moment you have an idea about prospectivity of a region to when you drill holes, to when you can establish a resource, can take multiple years and tens of millions of dollars. When I look at what we've managed to assemble here, is we've taken all those early years out of the equation by going straight after projects that had already been drilled, in some cases had economic studies, geophysics, in some cases had a feasibility study. If I look at the combined exploration, like the dollars, hard dollars that were spent on our projects to drill, to look for gold, it's almost $300 million. $300 million. And again, so what we have in terms of the total gold resources that we talk about, now I'm just talking gold only. I'm not talking about the uranium joint venture. I'm not talking about copper co-product that we have with the gold in a number of our projects in Alaska and in Colombia. But again, when you look at the sheer size of the gold resource portfolio, the 10.5 million ounces of measured and indicated resource, the over 13 million ounces of inferred resource, I get really excited about just the sheer size of that. And the sheer size of that puts us in a very unique category that no other pre-production gold junior company in the world has as many gold resources in the ground in a diversified portfolio as we do. And the fact that we bought these assets, the majority of our resources, at the most attractive time. You know, you use the analogy of buying your straw hat in the winter. or I use the analogy of, buying your Christmas decorations in January. We did exactly that. You could not replicate what we've done today. And the idea of buying 10 cents on the dollar is really only possible when JP Morgan and Bank of America are not calling for higher gold prices. In fact, I remember our Whistler project in Alaska when we bought it the summer of 2015. Goldman was calling for gold to go under $1,000 an ounce. And so this is truly, I think, a case of our team, our board, our management, our shareholders were very contrarian, not just for 1 or 2 years, but for 8 years. And I'm excited about what we've managed to put together and how we can really harvest it as we go forward. And as we go forward, Kenneth, we're still looking at acquisitions, just like we announced and announced 2 acquisitions just in the last 6 months. As our snowball effect gets bigger, we have access to opportunities that we're demonstrating we can acquire and add to the portfolio accretively. And look, at some point we get big enough, we become potentially a good opportunity for participating in this merger and acquisition cycle that's taking place in the gold sector right now, and is going to continue as the sector is in focus. And that's, again, it's exciting to be well positioned with our company to take advantage of this multi-year cycle for gold that we have coming, a bull market cycle that, again, could potentially be the biggest one we've seen for gold, and it's exciting to be part of that.
Well, you showed true resilience, and you're a real visionary, being able to take advantage and see through that, see the future, and invest with inevitability. So I want to encourage everyone to visit the company at goldmining.com. It trades under ticker symbol GOLD on the TSX and GLDLF on the US side. Amir Adnani, thank you so much for coming on Crush the Street with me today and giving us this important update.
Thank you, Kenneth. It was great to connect, and we covered some good ground. So thank you.